For a data-dependent Fed, the next economic reading arrives this week, CPI. Meanwhile, markets already expect the Fed to hold rates steady in March, but a rate cut in May remains in play. For a further economic read, plus much more, I'm joined by Steve Pagliuca, who is the Bain Capital Private Equity Senior Adviser, PagsGroup founder, chair, and CEO, and co-owner of the Boston Celtics. You've certainly got a busy slate of events taking place here, from the economy all the way into what impacts your other investments in the Boston Celtics later on this week. We'll touch on that later on. But as we teed up this conversation, Steve, I'm wondering from your perspective, if there is one specific point where data can certainly shift this Fed's mind about the pathway and the pace of rate cuts.
Well, data is always an important factor. I think that the data right now is this kind of wait and see. I think you have to step back from the whole situation and look at the fact that in the last 100 years, T-bill rates have been more 4 to 5% range. And it's really only been anomalous since the crisis in 2008 that we've seen, 1%, 0.5% interest rates. So we're more in what is, I say, a normal band of interest rates than usual. So I don't see them going down anytime soon. And I think they're going to have to watch to see if the economy is getting overheated. And we've had such an increase in the money supply. I think we're talking about a long-term, walk back of quantitative easing, which probably would necessitate interest rates in those kind of levels for a long period of time.
You're talking about an even higher for longer. Do you believe that the markets have actually priced that in, or have kind of that reality check baked into this number yet?
Well, it's not clear. I think there's some over-exuberance around cuts, and people have seen lower interest rates. But again, I think if they look at history, that's an anomaly. And actually, corporate earnings and profits look like they're coming out very strong. So low interest rates, as you know, fuel speculation. And that's what got us into kind of the bubble. I think we needed to do it to get out of the crisis, but now I think it needs to be walked back over a long period of time.
How is this earnings season, as you were mentioning earnings, and there's been so much focus on where margins really stand over the course of this earnings season. How has this earnings season held up thus far from your perspective?
I think very well. Companies are reporting, good growth, good earnings, and the United States is probably the most stable economy out there, and what I would say is the most global turmoil we've seen since the 50s, with the war in Ukraine, the war in Gaza. The China decoupling. So I think the U.S. has been kind of a safe haven for investments.
And so with that in mind, that global equation that you were laying out, there's a lot of focus later on this year with a record number of people heading to polls internationally. And here in the U.S., it could reshape, or at least give us some further indication of how our international relations will also overflow into and impact the business world as well in corporate America. What is the key thing that you're watching in this, what is expected to be an extremely vitriolic 2024 general election?
Well, unfortunately, we've been in a period of a lot of vitriol in the last 20 years. There's been a market change since the elections in the 80s and the 90s in terms of mudslinging and just the whole process. We've had that before in America, so it's not new. There have been very bitter elections in earlier countries' history. But we've gone into a period of polarization, which I don't think is good for America. And so I'm hoping we'll come back to some sanity in the middle, where people go to Washington and they want to get things done that are good for people, good for the economy, and good for the person on the street. So, but right now, it's become kind of a mud wrestling contest.
What are you hearing from some of the other corporate executives, and how they also are perhaps playing a role in making sure that they can do their part from a business perspective to make sure that, as you mentioned, the person on the streets feels better about their relationship with business, or their place in society, in the corporate and capitalist structure that we do have?
Well, I've seen a sea change in corporate America and just investing in general, where this generation and people realize that you can do good business and you need to give back as well. So I think corporate America has really stepped up in many shareable programs to support education, to support diversity. So I think we're in a good trend in that area. And my overall belief is that corporations, universities, and governments need to work together so we can all prosper. Each having a divisive approach or doing something different doesn't get us anywhere. So I'm hoping, again, we're going to get back to a period where people realize it's much better to be cooperative, to work together so that everybody can prosper, rather than having political sound bites to get elected on a short-term basis.
Certainly. I wonder from your perspective as well here, we got to talk a little private equity. Do you believe that there's going to be perhaps an over-exuberance even about AI in private equity that continues to move forward, or is there another hot spot that you see emerging?
Well, I think you have to separate two things out. In kind of really high growth markets, you remember the internet in 1999, people were signing term sheets in 5 minutes that invest in internet companies that would do anything. There's over-exuberance in these very hot growth markets. But needless to say, AI is as big as the internet, maybe bigger in terms of productivity. So there's going to be a lot of winners and losers, but in general, it has the ability to help transform and productivity in the economy over the next 10 to 20 years. So it is a very interesting area to invest into, but you've got to do that with realistic valuations, and some of the valuations are out of control right now.
Does that make some of the smaller unicorns, maybe even decacorns, more attractive or less attractive than the big mega cap tech stocks that have, and companies that have hordes of cash piles to throw at investing in either growing something up homegrown or themselves perhaps going and buying out one of the smaller players?
Well, I think it's going to be an interesting fight out there because the small companies can be backed by the large ones. They can be backed by venture capital. So there's plenty of capital that will chase great ideas, and AI is certainly one of them that will improve productivity for everyone. So there'll be a battle. I think the corporates will have some success. I think the venture capitalists have some success, but that's what America's about. It's about competition, and the best companies will win. I think this is going to be a little different than the internet because those companies you mentioned, the Magnificent Seven, most of those are natural monopolies. I don't see AI being a natural monopoly. I think there's going to be domain AI programs, language models that focus on different industries, medical, technology. And so I think there's going to be more room for many of the avenues to succeed rather than having a one network effect company that dominates everything.
Steve, just lastly, while we have you, we got to talk a little Celtics here. I would be remiss if we didn't bring up and recognize one of your players, Jason Tatum, going to his 5th NBA All-Star appearance. The significance of that for the franchise, but also you think about how much for the sports world. We've seen a lot of deal making taking place over this last year. Where does that continue to move from your purview?
Well, deal making happens for two reasons. Some franchises are sold because the owners have estate issues or they want to sell out. Also because of the promise of sports. So sports is definitely the unifying programming that gets the largest mass audiences. And in a world where we've now seen fragmentation of media viewing into streaming, digital viewing, it's a whole different world right now with many, many options out there. What is the unifying force? It's content. It's compelling content. So the internet companies want that content. The old broadcasters want that content. Streamers want that content, which makes the NBA and sports very, very valuable.
With that in mind, just lastly, while we have you, do you think there's a mega deal that's going to finally come through in the streaming landscape, knowing how much sports have really been kind of the crown jewel, perhaps for some of that viewing to remain consistent?
Well, if you look at the history of television programming, we've gone through phases of bundling, unbundling, rebundling, skinny bundles. And so we've been in a big phase of unbundling with streaming coming in and the internet players coming in. And so I don't think you can support the average consumer can't belong to 15 or 20 streaming services. And so you're going to see different types of approaches, and there probably will be some consolidation necessitated by the economics of the inability to keep up all those services for all those consumers and invest in new programming for that. So I think you'll see consolidation in the coming 3 to 5 years.
All right. Steve, thanks so much for taking the time here today. Steve Pagliuca, Bain Capital Private Equity Senior Advisor, PagsGroup founder, chair, and CEO and co-owner of the Boston Celtics. We appreciate it.
Great to be here.